Recently, President Trump brought up another policy idea, one that involves roughly $200 billion, specifically focused on housing and mortgage, with the goal of influencing mortgage rates. And as soon as people hear $200 billion, the first reaction is usually, that's a huge number. Does this mean home prices are about to move a lot? But before asking how big the impact is, there's a more important question. What is this $200 billion actually doing? Let's start with the short answer. This is not free money. It's not a direct subsidy. The easiest way to thinking about what it is in the mortgage system, it adds another buyer, someone willing to step in and take loans off the bank's hands. And that matters more than it sounds. Because when a bank decides what mortgage rate to offer you, it's really thinking about one thing. If I lend this money out, how risky is it? And how hard will it be to get my money back? But if the bank believes the loan can be sold later, someone else is willing to take it, then the risk feels lower. And when risk feels lower, banks are more comfortable lending and more willing to offer lower rates. So what role does the $200 billion actually play? That money doesn't go to buyers. It does not show up in your bank account. Instead, after banks issue residential mortgage, policy steps in to absorb part of that risk. The pressure on banks goes down. And when that happens, banks feel safer issue home loans. Capital flow more smoothly, and mortgage rates have room to gradually come down. And that's what matters. Now, is $200 billion a lot? Here's some number to understand. Even though it's focused on housing, the U.S. residential mortgage market is measured in trillions of dollars. So in context, this $200 billion is roughly about 1 to 2% of the overall market, which tells us two things. It's unlikely to cause mortgage rates to suddenly drop overnight, and it's unlikely to flip home prices in a dramatic way. But it does send a signal, and the signal is this. Policy is trying to reduce the cost of financing a home, not raise the barrier even higher. So what does this mean for regular people? If you're thinking about buying a home, this could mean if rates slowly ease, even by a small amount, your monthly payment could look very different. If you are thinking about selling a home, the next buyer is likely not an institution, but a household. And what they care about most is, can I afford the payment? So when I step back to look at this whole picture, I don't see a signal about home prices going up or down. I see a signal about cost. Is buying a home about to become more difficult or slightly more manageable? That's what makes this $200 billion worth watching. And I want to end this episode on this final point. No matter how the headlines change, no matter how loud policy debates get, your decision shouldn't be about guessing short-term price movement. It should come back to two things. What is your actual housing need? And does your current financial situation and investment structure support that decision? If those answers are clear, you don't need to chase every news circle. Policies change, market sentiment shifts, but your housing needs and your ability to afford them are what truly matter. I am Jen. I will see you next time.